Hey everyone, welcome back to Corporate Decoder. Today, BlackRock Enhanced Large Cap Core Fund Incorporated N-2 ASR just filed its latest registration statement offering up to 15 million shares, and I'm seeing some key details that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing signals a potential large share offering, and understanding the associated costs and risks is crucial for any investor. So what we're looking at here is a registration statement from BlackRock Enhanced Large Cap Core Fund Incorporated. This is essentially a filing to get permission to sell more shares down the line. Think of it as a company telling the public and the regulators they might want to raise more money in the future, and here are the terms they're looking to offer up to 15 million shares of common stock. This is a closed-end management investment company. What that means in simple terms is that it is a company that pools money from many investors to buy stocks and other investments. As a closed-end fund, its shares trade on an exchange, like a regular stock, unlike mutual funds which you buy directly from the fund company at net asset value. The fund's main goal is to provide current income and capital appreciation, meaning it wants to generate cash for investors while also growing the value of the investments. Now here is a critical detail for investors. The offering price for these new shares will generally not be lower than the net asset value, or NAV per S-share at the time of the offering. The NAV is basically the value of all the fund's investments minus its liabilities divided by the number of shares. This is designed to protect existing shareholders from dilution by making sure new shares aren't sold at a significant discount. However, they do mention that rights offerings, which are special offers to existing shareholders, might have different pricing conditions. Let's dive into the costs. This is where understanding the real impact of investing comes in. The summary of fund expenses is super important because it tells you exactly how much you'll be paying. For shareholder transaction expenses, they estimate a sales load of 1%. This is a fee paid on top of the purchase price. Then there are offering expenses borne by the fund, estimated at 0.02%. These are costs related to issuing the shares, like legal and registration fees, which are passed on to the fund and ultimately to all shareholders through lower overall returns. The biggest ongoing cost is the management fee, which is set at 0.85%. This fee is paid to the investment advisor, BlackRock Advisors LLC, for managing the fund's portfolio. It is calculated on the average daily value of the fund's net assets plus any proceeds from borrowings used for leverage. So, if the fund uses more borrowed money to invest, this management fee effectively goes up. Putting it all together, the total annual expenses based on these estimates come out to 0.93% of the net assets. That might sound small, but over time, these fees really eat into your returns. To make this even clearer, they provide an example showing what a $1,000 investment would cost over time. Assuming a 5% annual return and that a fee waiver agreement expires after the first year, you would pay $19 in expenses after 1 year, $39 after 3 years, $61 after 5 years, and $123 after 10 years. While this example gives a good picture, remember actual expenses can be higher or lower. Now let's look at the historical performance. The financial highlights table gives us a snapshot of how the fund has performed on a per-share basis over several years. For instance, for the year ended the 31st of December 2025, the net asset value, or NAV, per S-share began at $21.43 and ended at $22.62. That is a solid increase. The net investment income was negative $0.01 per S-share, which means they paid out slightly more in expenses than they generated in income from investments that year. However, the net realized and unrealized gain was over $5 per S-share, showing strong growth in the value of their holdings. Total return based on NAV was a healthy 25.43% for that year. It is also interesting to see the total return based on market price. For the year ended the 31st of December 2025, this was a very impressive 38.16%. This shows that not only did the underlying assets grow in value, but the market was also willing to pay a premium for the fund's shares compared to their NAV. This is a key characteristic of closed-end funds. They can trade at premiums or discounts to their NAV. Looking at the size of the fund, the net assets at the end of 2025 were about $927 million. This is a substantial amount, indicating a well-established fund. The portfolio turnover rate for that year was 66%, meaning they bought and sold about 2/3 of their portfolio. This isn't excessively high. Suggesting active but not frantic trading. This section details what the fund can invest in. They primarily focus on equity securities, including common stocks and preferred stocks. They may also invest in non-US securities and even explore emerging markets, which adds complexity and risk. The fund can use strategies like options trading and potentially leverage, which means borrowing money to invest more. Speaking of leverage, the fund is permitted to borrow money or issue debt up to a certain percentage of its managed assets. While they currently don't intend to do so, this option is available. The filing explains that using leverage can amplify both gains and losses, making the fund's NAV and share price more volatile. It also means higher fees paid to the advisor, because those fees are calculated on a larger asset base. This is probably the most important part for any investor. The risk section is extensive and covers everything from general market events to very specific concerns. They discuss the impact of recent interest rate changes by the Federal Reserve, trade policy uncertainties, and geopolitical developments. These broad economic and political factors can lead to significant market volatility, reduce liquidity, and increase default risks for underlying companies. The filing also mentions the potential impact of a US government debt downgrade, which could have severe negative effects on both US and global markets. A significant risk they highlight is the transition away from LIBOR to new reference rates like SOFR. While this transition has been ongoing, there are still residual risks associated with it that could impact the markets and specific investments. The new rates might behave differently than LIBOR, and their long-term performance is not yet fully understood. This section broadens out to cover all sorts of global events, wars, pandemics, terrorist acts, political instability. These events can significantly impact financial markets and the value of the fund's investments, and there is no guarantee the fund can manage its exposure to these conditions. The specific mention of the Russia Ukraine conflict and related sanctions highlights the current geopolitical climate. They also point out that government actions, tax law changes, or new regulations can unpredictably affect issuers the fund invests in, and even the fund itself. This includes the risk of being regulated as a commodity pool if they engage in certain derivative transactions. The fund is managed by BlackRock Advisors LLC. They are paid a fee of 0.85% of managed assets, and this fee is higher if the fund uses leverage. Importantly, there is a fee waiver agreement in place through the 30th of June 2028, where BlackRock agrees to waive management fees on certain investments managed by BlackRock itself. This is a common way for asset managers to reduce the immediate expense burden for investors. The filing details how the fund calculates its net asset value or NAV each day. It involves valuing all the fund's securities and assets and subtracting liabilities. The methods for valuing different types of assets, like equities, fixed income securities, and derivatives, are laid out with a significant focus on fair value pricing when market quotes aren't readily available. This fair value process can be complex and subjective. Shareholders automatically have dividends and distributions reinvested unless they opt out. However, there are fees associated with reinvestment for open market purchases, and if you direct the agent to sell shares. The filing notes that the fund might offer rights to existing shareholders to purchase more common stock. These rights can be transferable and are often offered at a discount to the current market price. This is a common way for closed-end funds to raise capital, but it can also lead to dilution if not all shareholders exercise their rights. As expected, there is a lengthy section on taxes. For us holders, distributions are generally taxable as ordinary income or capital gains, depending on their source. Any return of capital distributions reduce your cost basis, potentially increasing your future tax liability for foreign investors. There is a 30% withholding tax on ordinary income dividends. The filing warns that tax laws are complex and subject to change, urging investors to consult their own tax advisors. This part talks about the fund's corporate structure and provisions that could affect shareholder power. It mentions that certain decisions require a supermajority vote of shareholders, making it harder for shareholders to enact major changes like converting to an open-end fund or merging. Here they reiterate the key difference between closed-end and open-end funds. Closed-end funds trade on an exchange and don't redeem shares at NAV, meaning you might buy or sell at a price different from the fund's actual underlying value. They also highlight that closed-end funds can trade at a discount to NAV, and the fund may undertake actions like share repurchases to try and narrow that discount. For the BlackRock Enhanced Large Cap Core Fund Incorporated, this filing for up to 15 million shares signals potential growth or the need for capital. The key takeaways are the explicit costs like management fees and potential sales loads, the complex risks associated with market volatility, derivatives, and regulatory changes, and the fund's structure as a closed-end vehicle that can trade at a discount to NAV. The fee waiver is a positive for investors in the short term, but the long-term expense ratio and the potential for leverage adding volatility are significant considerations. For investors, understanding the historical performance shown in the financial highlights provides a good baseline, but the extensive risk disclosures absolutely must be read and understood. The market price versus NAV is a crucial factor for closed-end funds, and this filing doesn't guarantee a premium to NAV. The risks around market disruption and reference rate changes are particularly relevant in today's economic climate. What I am actually looking for is how effectively they deploy any new capital raised and whether the management team can navigate the identified risks to deliver on their income and capital appreciation goals. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join the Discord.